Hey everyone, welcome back to the Daily Gold Podcast. We're wrapping up the week here. It's Friday afternoon, and we're speaking with Dave Skarica of AddictedToProfits.net. You know, Dave, last couple podcasts we've done together, it's been kind of difficult for the gold sector, but, you know, we were talking before this interview, and we're starting to see a little bit of strength, and especially in gold. I got to tell you, I really like the way that the gold chart looks, especially the last couple of months. Even this month, we see that gold has made a higher low. It's bounced off the 300-day moving average twice. The 300-day moving average supported the bottom at the end of last year. Do you think gold could kind of begin a little uptrend here? And also, what would the outlook be for the rest of the year?
Yeah, I actually think, and I've been saying this for about the past month or so, like I'm really getting bullish on the gold stocks. Like all of our metrics, I actually just put out an issue that talked about this, and you take the metrics of like the gold divided by the price of the HUI or the gold divided by the price of the XAU. We're basically going back to the 2008 lows in terms of the price of the metal compared to the price of the stocks. And obviously we've seen really negative news in some of the stocks over the past year, which might help them, which I'll talk about in a little bit later on in the podcast. But yeah, I agree with you. I think that we're seeing these really nice basing patterns. The move down to 422 in the HUI, in my opinion, was a false breakdown after it looked like we were building a base around 440. So, and we're almost at 450 today. So I really think that we can move higher. And what I think is that it might move further and higher than people think. I'm looking at like maybe a move in the summer, and this often happens during the seasonal time frames, that we kind of maybe start pressing against that higher end of the range again, go to 550 to 600 in the HUI. Then we see kind of the summer pullback, and then we really get ready to break out late in the year. Now, I thought that was going to happen last year, and obviously the weakness of early this year, I think, has pushed that back another year. But that's what I really think is going to happen, is that we're going to see a rally followed by a pullback, and then the big breakout late this year, early next year.
Dave, what's really interesting to me about the mining shares are, if you look at the input costs, you look at the gold oil ratio. I like to chart gold against industrial metals or gold against steel, because we know that steel is an input cost in mining, and oil is, of course, about 25% of the entire cost of mining. And you look at those things, and they've been holding up very well. I mean, it looks like the real price of gold is going to start to trend back higher. And given those things, we've seen the companies that have been operating well, without any major mishaps, they've been making a lot of money, and therefore the gold stocks have been really cheap. And so that's what's really surprised me about the past 9 months or the past year and a half or so, is that we have seen rising earnings, yet the sector has kind of tanked despite this environment of record profits, record cash flow. And so how do you reconcile that? And also, given those things, if we see another move higher in gold, aren't people going to start to get a lot more excited and realize that they were wrong about gold going back to 1,300?
Well, I think like few of the factors here, and I just did, by the way, a whole issue on this. And part of the issue was kind of saying that these are the arguments for why the stocks have lagged. And a lot of the arguments don't really hold water. Like one of them has been this whole argument they don't have good managements and the earnings have been stagnant. And yeah, and we've seen even the companies that have had problems, though, most of their problems have like been 1 or 2 quarters of kind of one-time events where they have to do some kind of write-off, and it's hit, obviously earnings over the course of a whole year. But they're not like real, like no company that I know of has had some structural problem where it's like, you know what? Our production the next 5 years is now going to be 50% lower than we thought, or than it is today. It's like most of these companies are still kind of slowly growing. Maybe some of them aren't growing as quickly as they thought, but a higher gold price should cover that up, and maybe some expenses are higher than they thought. So I think a lot of it has to do with competition from other asset classes. When you have Apple at $600 and you've got LinkedIn at over $100, and obviously you've got the Nasdaq up near multi-year highs, and the S&P is back over 1,400. I think it's just that people don't feel the need to buy gold and precious metal stocks. And with less money flowing to equity markets as a whole, that even takes away from gold stocks even more. And then you've got these handful of companies that have had problems with production and earnings. So a few investors might look at that too and say, well, I really want to stay away from that sector as well. And there were some excellent articles out recently in the Globe and Mail about a couple companies that have gone way overboard in terms of their capex costs, like some of the newer producers. So obviously that would scare people away as well. So I just think there's been a few factors, and then that's dragged down the whole sector. Even the companies that are, say, royalty companies that are seeing near record earnings, as you just said, or even some of the large caps that are seeing near record earnings have been kind of dragged down from the rest of the sector. But I think in the end, the real answer is, and I hate to be, I hate to not give you, I hate to sound like a politician or something, kind of give you a wishy-washy answer. No one knows. No one really knows how come the gold stocks have lagged so badly. How come, despite like money printing, gold higher, the stocks higher, more liquidity, higher stock market, how come the equities have performed so poorly? Nobody knows these things. Why isn't more money flowing into it? We don't know why this hasn't happened, but what we do know is you want to buy assets when they're cheap. The gold stocks, compared to the gold price and earnings growth and all these things, are about as cheap as they've ever have been. By some metrics, they're cheaper now than they were in 2008. And now is the time that you really want to start averaging in these stocks. And me and you have been saying this for the last month or two. And the HUI has kept dropping and the gold stocks have kept dropping. But I really think this is the time that you want to start getting into some of these things.
Right. Well, I mean, I think you said it there with the competition from other assets and the fact that, I mean, there have been some companies that have had mishaps, and also, I mean, the capex for certain projects, I mean, have looked really, really daunting. And I've heard some, other guys in the industry, some analysts talking about, what you need to look for, the higher margin deposits and maybe smaller things that aren't super high capex. So what are your thoughts about those things?
Yeah, I would say I've always made the comment that the toughest transition for a miner is from an exploration company into a production company, unless, even when it's small production. But if it's a large project, that makes it even worse. And I would definitely say that if you've got, like, if say you invested in the company, it was an exploration company at 40 or 50 cents, and that you're lucky enough that stock has gone to $1.50 or $2 or something like that, and now they're going to say, oh, we got to ramp up the capex spending to become a producer. That's definitely when you want to take your money off the table. You want to get some skin out of the game. So I would agree. The smaller projects are okay, but I think now you got to look at it this way. Even the ones with the larger projects who have spent most of the money, they're probably a good risk reward. A lot of these companies have come off a great deal because the fact they've come off so much, where's the rest of the downside at this point? So I think we're in the stage of the market where, because everything is so beat up, you're going to see a lot of things just move because it's so beat up,
Right.
If something goes from if something goes from 20 cents to 40 cents, so $2 to 40 cents, it only takes a move back to 80 cents, which is 20, which is a 40 cent of the $1.60 loss, 25% of that loss, to double in value. So it's kind of like dropping a tennis ball on the ground, and even if the ball only bounces back a quarter of the way from where it was when it hit on the ground, that's actually a big bounce.
Right, and just to expound upon your answer, we've had these conversations before where, now it's apparent that the junior market sucks in general, as Rick Rule always says. I mean, it's interesting because there's a lot of people who make a lot of money off the junior market, but they know that it generally sucks because only 5% of the companies they end up being viable, and so on and so forth. And so, we've just had this bad period of 12 to 18 months, and now we know juniors suck, and especially the non-producing ones. Yet now is the time when those companies are actually trading for pennies on the dollar. Now is the actual time when you want to go buy them, when we've been reminded that, generally speaking, the industry sucks.
No, and I agree with you. I think one thing you got to look at junior companies, and I've been guilty of holding some of these companies down over the last year. And part of the reason I didn't sell was that, we had a nice bounce in 2009, 2010 into 11, but it wasn't like this rip roaring move where everything got real frothy. But I think one thing you have to understand is that when these things do move, you should just take some, again, money off the table. And then, like you said, just wait until they suck again. Even if you miss out some of the upside, and you miss some frothiness for a year or two, this always kind of happens in them, and like I'm seeing companies that have had projects falling through, and were 20-cent, 30-cent deals are now 2 or 3 cent deals, and they're probably going to go under because they're going to run out of money. And if you would have told me that was going to happen with silver at $30 an ounce and gold at $1,600 or $1,700 an ounce, I would have said no way. Like, even then you would have the ability to finance and whatever. So it's just funny to see that, yeah, the market is almost as bad as it was in 2008 or the late 90s after the collapse of Bre-X. And, that was when copper was under $1 and gold was under 300. It's just funny to see the junior market in such the doldrums like that with these still pretty good commodity prices,
Yes, and so do you think if we get a move in, let's say, gold over $2,000, we get silver over $40, do you think that's really going to reignite this bull market? We're going to start to see more speculation and better valuations across the board?
Uh, yeah, I think that might be like kind of like round numbers like that. Obviously, silver might even be 50 the high, and gold 2,000 might be what does it. That might just trigger some kind of interest in these stocks and the like. I think it might take something like that to happen.
Right. I did pin you down there. Kind of a tough question.
Well, it's a tough question because I don't know what it's going to be. My opinion is it was always going to be like a currency crisis. Like basically the USD really starts to break down. And other than the euro, it doesn't look good against most of the other major currencies, against especially the Canadian dollar and the British pound. And so I've always thought that the dollar would break down. You wouldn't get a collapsing stock market because obviously the dollar breaking down is good for a lot of the multinationals that are in the Dow and S&P. But the dollar breaking down would make people realize, wow, we're in the midst of a currency crisis. These gold stocks or gold are a real way to protect myself. And I thought that would kind of be a way, like that would be actually more the trigger. So maybe the dollar index going through 70 is more what I'm looking for rather than gold going through 2000.
Right. Okay, Dave, before we close here, is there anything else you want to add that we didn't discuss?
Yeah, I think like another important factor to look at here, and I don't think you can really discount this, is that the Indian central bank cut rates within the last month, and they cut by more than expected. They cut by half a point. People were expecting a quarter point cut, and they're going to continue to loosen, right? And they're going to continue to, really, continue to cut rates and whatever. And that is going to be inflationary down the line because it's the largest or second largest population country in the world, and now a country that's getting into the top 10 or 20 economies in the world that's going to be loosening monetary policy. And I think the Chinese central bank will follow. And then when the Chinese central bank follows, you've got two of the large central banks in the world that have been relatively tight in the last year that are now going to begin to cut interest rates, and that I think is really going to help the precious metals market because that's going to be more money printing essentially like flowing into the system. So I think that's another factor to watch for, and I've been expecting those rate cuts to start here in the second quarter and going into the third quarter.
All righty. Well, Dave Skarica of addictedtoprofits.net, thanks so much for your time today, and look forward to talking again soon.
Thanks for having me.